Most hedge funds are still betting the sell-off is done. Are they right? And how should you position your portfolio? Jack Ablin is CIO of Cresset Capital, and Evan Brown is with UBS Asset Management. Jack, look, there's still risks. I mean, a company like Starbucks is a perfect example of what Steve is talking about. Can they still take for granted that China is going to be their second home market?
Yeah, I think, part and parcel with that assumption is that there will be a resolution of this trade dispute by the end of the year. And I don't think that's necessarily the case. As we just heard from Steve and we've heard from others, is that this relationship is much more complex. This is not necessarily a trade negotiation. This is a fight for global dominance in technology and in healthcare. And it's not something that's going to be resolved very quickly, and certainly not with just a couple of trade agreements and handshakes.
Right. But, Evan, I guess the question is what's priced into the stocks now who have this exposure? Should investors discount the possibility of that lessening, or should they say, well, look at what happened with Huawei. Maybe we're all going to come to a deal here?
It's tricky. We have this unstable equilibrium now where the markets think ultimately President Trump will cave, right? That we don't want to see too much pain in the stock market. But the more that the stock market holds up and the more the U.S. economy holds up, the more emboldened President Trump will be to push. And he's not incentivized to de-escalate until that happens. So, our bias is actually that he will push and President Xi will push until something breaks, essentially, and then maybe there will be enough pain to bring both sides together.
Meaning there might have to be a market,
exactly,
a much sharper market sell-off. But he barely reacted to the one that we've seen so far, the president.
Yeah, so there's an interesting debate going on the president's incentives, and is he focusing less on the stock market and more on, I want to be the one who's tough on China. He's focusing on Joe Biden, and Joe Biden's popular in the Rust Belt, but also being tough on China is popular in the Rust Belt. So maybe he's de-emphasizing the stock market, re-emphasizing the being tough on China, and that could lead him to have a little bit more of a downside before he actually caves on trade, essentially.
Jack, when we're thinking about S&P 500 and where it's going to get its growth, where the companies are going to get their growth from, and we are thinking today, at least, that China is going to be a big growth market for a lot of sectors out there, particularly technology. Should we then think, maybe this is a long-term question, not a tomorrow question, but should we think about a cap on valuations because maybe the growth won't be as blue sky as we all thought because of what's going on with the trade war?
I think the growth will be there. It's really just the processes, the mechanism for that growth. Here's if you take technology and even large industrials, here's a group of companies that essentially optimize their global supply chain based on how the cards have been dealt for the last 40 years, and now they're seeing an abrupt reversal. So the question is, all right, how are they going to adapt? How will they pivot? And you're right, getting boxed out of China is going to hurt. But I do think that they can continue forward with, production and so forth. But they're going to likely, if these trade negotiations don't go well, they're going to need to shift. And whether that comes back home to the U.S., which is certainly, one possibility, or some other country in the region, remains to be seen.